Um, Thanks for joining us today to go through our session on business protection. It's certainly an area of some significance in terms of the queries that we're facing coming through from members over recent times. What we're going to do today is we've got David Coyne based in Melbourne, Rob Brauer over in Perth. If there are any questions over the course of the meeting, at the bottom of your screen you'll see a Q&A function. If you'd like to ask a question during the webinar, please enter it there. You can do so anonymously. We will not disclose who the question came from, so please feel free to use that. Otherwise, let's get into it. And thanks, David and Rob, for joining us today. We spoke yesterday afternoon about some of the queries that we're facing. I guess one of the major ones to start us off with a chunky one is people trying to understand if their business is still viable. How do we go about doing that? What are the steps? What's the process?
Maybe, Barry, it's David Coyne here, and welcome to everybody on the webinar. If I could start that by defining or setting what the definition of solvency is in the Corporations Act. It's not going to be technical. It basically says you're solvent if you can pay your debts as and when they fall due. And therefore, the corollary is you are insolvent if you cannot pay your debts as and when they fall due. It is as simple as that. So it's on a cash flow basis as to whether you're solvent. Can you pay your debts as and when they fall due? Not a balance sheet basis of assets over liabilities. And that's the measure by which the conduct of directors and officers and people in business will be judged in hindsight in relation to solvency and ongoing trading.
I think just to add to that, David, there is some, so when you understand that definition, it gives you a little bit of flexibility as to how you can then address it. It talks about debts and it talks about as and when they fall due. So partly it's about, can you renegotiate what the quantum of a debt is, or can you renegotiate when the timing, formally renegotiate when the timing of that debt falls due. And that's when, I guess, restructuring and turnaround professionals start to help businesses in staggering those things out so that you can still fall on the right side of that definition. And indeed, you know, a raft of measures and announcements that have been made from all sorts of stakeholders, which we'll touch on a little later, are all designed to try and give some comfort almost around this definition and to give a little bit more liquidity so that you stay on the right side of that definition. And as the government likes to say, building a bridge to the other side of this crisis.
Okay, so looking at that definition, David, the test is if you can pay your bills, you're solvent. If you can't, you're insolvent. But what about, you know, when you're looking at assessing the ongoing viability of the business? You know, we had talked about some restrictions in terms of government restrictions that, you know, simply mean that a business cannot trade. Whereas in other cases, it's a behavioural change where customer behaviour is completely changed over the piece. So, you know, what are the tools that people should be using to assess that viability going forward?
Well, one of the very dramatic things is the speed that this has hit businesses, and also the significant amount of changes that we've seen in the last 7 days in terms of the government's approach to what they're doing and what they're trying to do. And we know that that's not over. They're still going to have potentially a third stimulus package. And what people need to be looking at is going, right, well, what is going to happen to my business in the next, ideally, 3 months? That's what we would previously have looked at and said, what's going to happen in a stable environment? You'd be looking at 3 months. However, at the moment, if you were in hospitality last week, you were going to think, in Melbourne anyway, I'm not sure, it's not Australia-wide, you'd be thinking, this is going to be tough, but we can get through it. We can remove some chairs and comply with their restrictions. Then over the weekend, they come out and say, you can't do hospitality anymore in Victoria. So from where you'd already adjusted your plan, you've now had this imposed upon you over a weekend without any notice. So your planning for the next 3 months has completely gone out the window. And whereas it was a crisis, it will be, I think, fatal to a lot of businesses in that industry if they can't adapt in some other way. And I don't know how they can. The other side of it is businesses that are being impacted through either a reduction in demand, but not an elimination of their demand. And therefore they have to start looking and saying, well, we've lost 25% of our revenue because of this. Is that the way it's going to look going forward for the next 3 months or 6 months? And if it is, how can we adapt our business to cope with those lower levels of revenue? You have to look then at your cost base. What is my cost base? As Rob alluded to earlier on, how can we adjust to your cost base to match your new revenue if you can't increase your revenue stream? And one of the biggest costs for a lot of people is going to be staff, and the other big cost is going to be premises. Your rent and your wages are going to be your big costs. And those are two areas that you're going to have to look at quickly. You're also then going to have to look at, on your supply side, if you're buying in and manufacturing whatever, are your suppliers going to be able to continue to supply you? And on the customer side, are your customers going to be able to continue in business and pay you on time? There's no point in you supplying them if you think they're not going to be able to pay you when the bills become due on 30 days or whatever your terms are. And so it's looking across all areas of the business to say, right, what is the new level of business? How do we adapt our costs to that? And are we satisfied on the supply and the customer side that they're going to be able to continue?
So this is the crux of it, viability. This is really the guts of it, and it's very difficult when you're in crisis mode and things are moving so quickly, and many businesses' revenue has gone, has fallen by nearly 100% in a very short period of time. But no matter how much it's changing in your own world, I think the most practical things that you can do is firstly inform yourself, and I'll come back to each of these. Inform your stakeholders, take some action, and effectively hoard cash. But if you take each of those in turn, the things that David's talking about, the most practical thing you can do is start with a cash flow forecast. And it's a 12, 13-week cash flow forecast. I know when you're in crisis mode, it will be difficult to stop and take the time to prepare that, but it really is the best tool that you'll be able to have. And from that, you'll be able to base a whole range of decisions and actually see how much you'll need to move the cost side of the equation or the employee side of the equation, and how long you've got. Now, a lot of people find cash flow forecasts difficult to put together, or say that it's very difficult to forecast in my industry or in my business. I try and break it down. It doesn't need to be perfect, but the basics are quite straightforward. You are literally putting in for each of the 13 weeks. Unwind your opening debtors position if you have some. When are you going to receive them? And then when are you going to receive future sales? And then on the cost side, line by line, what are the critical non-movable payments that you have to make? And then what are the other payments that you're due to make? And what leverage do you have, or capacity do you have to change the dates of those? Start to piece that together, and the picture will start to become clear to you. The first cut might look pretty terrible, but that tells you exactly what you need to work on and where you need to focus. Is it the supply line? Is it my employees? Is it all of the above? And that's when you start to put a plan in place. Start listing out the measures that you'll take. Which suppliers do I need to talk to? What does my employee base look like? How flexible is it? How many of them are casual? How many of them are full-time? Do I need to talk to an employment lawyer, because it is a bit of a complicated area and you don't want to trip up a fair work claim unintentionally. These are the sorts of, I think, is really an important tool to do, because you can also reflect in there all the other measures that these stakeholders are now offering up and have done so very quickly. All the banks are offering 6-month deferrals on repayments, or even short-term unsecured loans at low interest rates. Even seeing some of the bankers locally in Perth this week, they are just so inundated with requests and queries that everything is many things are being approved in a short period of time. They just do not have the capacity to go through the normal process. If you've been a viable customer with the bank for some time, you are going to get their support. The ATO is offering up deferrals on PAYG and other tax payments. If you've got asset finance, the banks are offering up delays on those terms. The landlords would be the other key one. Now that's, commercially, you would like to think that most landlords understand that they need to be part of the solution here and take a haircut like everybody else. That will be a case-by-case basis. But equally, on the other side, if your landlord has borrowed funds to own the property that they own, they too will need to go to the bank and seek some relief, and you would expect that would be passed on. So you can see that all these different levers and all these measures, they are all reflected in that cash flow forecast that you're preparing, and that's why it's a helpful tool to keep going back to see where you're at, to make sure you can stay on the right side of that solvency definition, or if not, how much leeway you need, how much additional support that you need to go and find.
Okay, we've had a question put in, Rob, which sort of relates to the points you make. What happens in relation to rent? So I take it from your remarks that speak to your landlord quickly and practically would be a recommendation.
So that, I mean, commercially, the landlord still wants you to be there on the other side of this because they don't have another tenant ready to move in, presumably. So I think they're going to need to, they don't have the same government pressure on them as other stakeholders like the banks or the ATO. But absolutely, you would expect that significant savings or rent holidays effectively should be on offer for many businesses. Yesterday, just down at the local shopping mall, even at the local hairdressers, the 70-year-old there is there two-finger typing a letter to his landlord. He's terribly worried about his own health and his own business. Whereas I'm saying to him, don't call, just almost stop paying. Pick up the phone call, speak to your landlord. They are going to have to come to the party. It's not going to rely on a craftily written letter from you to get that accommodation. Everybody in the shopping centre is going to be in the same situation. They're going to have a unified response. Share with him, start the conversation, share with him the information of where you're at. And no matter what size of business it is, even professional services businesses like our own, we may well be having the conversation with our landlord. So again, I don't be shy to ask for what you want, to do it early, and I think that puts you in a reasonable position.
Barry, if I can come in on that approach applies across the board in terms of communicating early and clearly with all the people that you're engaged in. The banks at the moment are accommodating. What the banks really do not like, and using that loosely in terms of finance companies, they do not like surprises. So you need to get on the front foot and be open and frank with them and tell them your problem and tell them what your desired outcome is. What do you want them to do? They mightn't be able to do all that you want them to do, but if you don't ask them and tell them clearly what you want, they won't fully understand the whys and wherefores of what you're trying to do with your business. If you need a deferral for a couple of months, whether it's with your landlord or with your bank or whatever, tell them what you want and tell them why. I'll give you one example of a small business that spoke to me last week. They, in hospitality, so they had to shut down. They realized that. They were stressing significantly about their personal exposure because it was a sole trader, or it wasn't in a company, it was just in the individual's name, and obviously therefore the lease was theirs personally with 18 months to run. They were talking about bankruptcy, they were talking about everything. And I just said, stop now, go and see your landlord tomorrow, tell them you're going to be shutting down, tell them you realise you're going to lose your bond, but can you get out of the lease at the end of March? 1 hour with the landlord and they got that result because the landlord knew the pain they were suffering. And so it's being open and upfront and very, very frank and very, very clear. And as Rob said, no fancy letters, just spell it out really simply so that there's no misunderstanding on either side. And it's that you have to apply to all the parties that you're engaging in, whether it's the banks, the tax office, your suppliers, even your employees.
Okay. We've had another question around hospitality, David, just when you're on that theme around, what happens for hospitality workers, many of whom are on work and holiday visas that we would encounter in terms of Centrelink support. So as an employer, what should we be doing to try and signpost to the people who have been part of our business being stood down, that they don't end up having to queue outside Centrelink for hours?
Well, first of all, I'm not sure if they're on holiday visas, whether they can qualify for Centrelink. I just don't know the answer to that question, so I can't comment.
It might be
on
something for Thursday.
In terms of your business, because they're probably going to be casual employees, if you're trying to cut costs, they're probably going to be the first ones that are going to go. If you have people on other forms of visas other than holiday visas, if you've sponsored somebody to come in, and I know in a lot of hospitality there are chefs and other more expert than casual wait staff who are being sponsored to come in. If they lose their jobs and they lose their sponsorship, they have 28 days to find a new sponsor and a new job, or they are likely to be deported. If the company goes into any form of informal insolvency as an administration or liquidation, then the obligation is on the liquidator or administrator to inform the department that those employees have been terminated, so that the department knows who's on the list for deportation in 28 days if they cannot get another sponsor. In the current environment, they're going to really struggle to get another sponsor because there's no jobs in hospitality at the moment.
Yeah, that is quite distressing, but David's right. That is the reality. And again, if you're trying to save your business, these are the sorts of unfortunate decisions that people are being forced to make.
Okay. David, you used the term of bankruptcy in the response earlier, and I think it does carry a degree of fear and the unknown and what damage that might do. But yesterday when we were having the brief, yourself and Rob talk about the other routes that a business can go down. Will you both expand on that, please?
Okay, I'll jump in here. Just if I start by just going through what the different types. Bankruptcy relates to an individual. In Australia, you'll hear about it in the States where they have the bankruptcy code in Chapter 11. That's their version. It's different. That's corporate. In Australia, bankruptcy relates to an individual, the formal issue of bankruptcy. In relation to companies, the types of formal insolvency appointments are receiverships, administration, and liquidations. Receiverships is where you have given a mortgage on your business, the same as you can give a mortgage on your house. You've got finance from a bank or another finance company, and you have given them security over your business. They then appoint a receiver to look after their position. The receiver will go in and take possession, probably sell the business, purely acting in the interest of the finance company to get the money back for them. An administrator is generally appointed by the directors. The administration is a really powerful restructuring tool. I think we'll probably see a lot of it in the coming months. Under administration, the company is protected for a minimum of 5 weeks, whilst the administrator investigates the affairs of the company and tries to come up with a rescue plan. The purpose of administration is to have the business survive and get a better result and keep it going and get a better result than you would in an immediate shutdown through a liquidation. So administration is a restructuring and holding tool while we do that. And then the last one, liquidation, is when you're closing down the business and it's all over. So in the current environment, administration, I think, will probably, for businesses that do hit trouble, be the most effective if they've got a viable business. It works really well because everybody is ring-fenced. The business is ring-fenced from all its pressures. We don't have to pay existing creditors at the time. We can continue to trade. We can continue to employ. We can continue, we could explore selling the business. We can restructure. We can terminate staff. We can shut down parts of a business. You'll have seen it in some of the retail administrations that have happened recently, where they slowly shut down a number of stores to get to a core number of stores that is still leaves them with a viable business. That can be done very, very effectively through the administration process. And then, as I say, the liquidation is where the business is not viable and it's purely a close down of the business.
Yeah.
Going back to employees, if I can just mention one thing about employees, which is very pertinent at the moment. There is a safety net scheme in Australia called the Fair Entitlement Guarantee, which will pay out employee entitlements if there isn't enough money in a company. At the moment, that is only available if the company goes into liquidation. It is not available in administration. And the recent changes that have put through have not addressed that. There is pressure coming from the insolvency profession to allow employees to be paid out in administration rather than having to wait for the company to go into liquidation, because that obviously can speed up their access to that Fair Entitlement Guarantee Fund, whereas the administration can take 5 weeks, or it could take longer in certain instances before the employees can apply for that support from the government. So those are the basic differences between what you'll read in the paper of receivership, administration, and liquidation.
Just a couple of comments in addition to that. So receivership, where the bank moves in, I think in a world post the Banking Royal Commission, and particularly now when everybody, including the banks, can't be faulted for the amount of support that they're trying to give corporate Australia, the likelihood of a bank moving in to appoint a receiver at the moment is less likely, unless there's evidence of fraud or other misdoings, or you've been an underperforming customer who's not engaged with your bank for a significant period of time. That is less likely to be the bank's first reaction, which means that if you do need to go through the other types of restructuring, which, so first of all efforts are on solvent restructuring, which is the sorts of things we've been talking about already. But failing that, and you go to a formal or insolvent restructuring, voluntary administration, I mean, it sometimes has a bad name, but really it is Australia's way of saving businesses, saving viable businesses that are going through or that are insolvent. And maybe it's worth just giving sort of one example to see how the voluntary administration regime can work. So, for example, a recent job, a civil contractor, maybe a $10 million turnover business, so an SME type business, it still had access to a few $100,000 of cash or personal liquidity, but it had a cash flow forecast, and he knew that 2 weeks from now, he would have burnt through that cash, he would have been insolvent, and there was no way back. So instead of letting that happen, he proactively appointed a voluntary administrator and proposed what they call, he made a proposal to his creditors, and we call it a deed of company arrangement. And that basically says, I have a pool of assets still available, but I need you all to compromise your debts. And if you vote for that proposal, then on the other side, I take control of my company back and the company can continue to trade. Now, in this particular, and the deed of company arrangement is very, very flexible. There's no limit really on what you can do, because ultimately it needs to be approved by the creditors. So if it's not good enough, they won't vote for it. But in this particular one, the pool of money that he had acquired, he was able to choose which directors got how much, what cents in the dollar outcome. Some might have got a very high cents in the dollar outcome, typically ones that he had a personal guarantee exposure to, and others that he didn't have an ongoing relationship with, such as the ATO or other suppliers he no longer needed. He sort of left them behind and gave them a very small cents in the dollar outcome. Now, after a 5-week period, he was back in control of his business with a clean balance sheet, and he'd saved the business. The alternative would have been that he did nothing for another 2 weeks. He burnt through the remainder of all his cash reserves. And then when he finally got to a point where he couldn't pay wages or whatever other event might have happened that forced him to close, he would have had 0 options available to him at that point, absent an external party coming in. So in that instance, he probably would have gone straight to liquidation, which means everybody loses really. And there's liquidation is the end of life. So the administration tool can be quite effective. It's even more effective when it's not when you don't leave it to the very end. And that's why that early conversation to understand what your options are, and the options, the first thoughts will always be, what are your solvent options? How do we solve this solvently? Who do we speak to? What stakeholders do we need to get their agreement to? But it does need their consent and their input. But if we can't do that, then sometimes there are real benefits that can come out of the voluntary administration regime in that scenario. Liquidation is typically when people have left it too late and there's nothing left to save.
One of the things that has come through in recent weeks, as you know, there have been restrictions in terms of other countries, and particularly our neighbours to the north, is the complexity of international supply chains and how this current situation has really impacted that. If you're a business who is worried about parts of your supply chain, have you any advice to how to broach that conversation as a business owner, where you're not seen to be, you know, putting undue pressure on your suppliers, but you actually want to get a read in terms of their viability, which feeds into yours?
Well, I think again it comes back to what we're saying about if they've got local representatives, I would be getting, well, hard to get in front of them these days, face to face, but I would be getting on the phone and speaking to them again. And it's very hard to get guarantees if it's coming from overseas in terms of what stage it's at. And I had an incident with a company recently. They're still going, thankfully. They were 100% reliant on supply out of China. They were importing and distributing 100% reliant on supply out of China. They worked on very tight, just-in-time supply. They had nothing for 2 months. So they've had no sales for 2 months. And so far, they've kept their business in place and intact because they've been putting money back in to keep the business running. They've been having discussions with their suppliers in China to see where they're going. They can't do anything out of China. Factories were shut down, so there was nothing that could happen there. All they've been doing and all they've been able to do here locally is to try and look around to see how quickly they can get other supply chains in place, other options that are there. So anybody that is in that situation where they have that supply coming in from overseas, I'd be looking for alternates, preferably locally, but you're going to struggle to get them, or you're going to struggle to get them at a competitive price, but at least with other producers overseas, so that you're not stuck with that situation of having only one supplier for key components. It's easier said than done, and I fully appreciate that, but it's about getting on the front foot, discussing it with them and discussing it and getting out there and seeing what else is available.
Yeah, David's right. I mean, it's a crisis. Your contingency planning, you should be seeking what alternate suppliers are available. But in other instances, and this won't work for all businesses, but it's not unusual. So, you know, I'm in Perth. There's a range of mining companies that go through some distress from time to time. You know, one solvent restructuring tool we try and use with them is when we get their top 4 or 5 suppliers and we get them all together and try and get them all to agree to some sort of sharing a pain and gain type mechanism that might be shared to future profitability, future income, the rise or fall in a commodity price, so that everybody's locked in saying, okay, we're all taking some pain now, but when this business comes back and we're profitable again, you will pick up what we owed you and more on the upside. And some people are up for that, faced with depending on the strength of your relationships, depending on, you know, you could be a critical customer for them, and that's really in their interest to see you to survive. And if they can, they may try to accommodate you. So again, it's, you know, the fundamental message is just to start these conversations now, but there are some innovative ways, if you like, to try and you know, get people collectively to work towards a solution.
The other thing I'd add to that is that this is a crisis situation and it's rapidly evolving. Last night, the UK announced the biggest shutdown, the most drastic moves. They're also talking about closing the ports and airports in the UK. Now, if other countries start taking that approach, nothing's going to move in terms of product around the world. So in terms of, you know, this has to be constantly monitored, as the cash flow has to be. Every day you have to be looking at it and saying, are the assumptions that I made yesterday still valid today? What do I know now that I didn't know yesterday? How can I update it and get this plan that I have to be the best that it can be today? And it's going to be for the next probably 6 months, it's going to be nearly an everyday review of the plan. But that's what crisis management is. You're constantly looking at what's in front of you and trying to get that information and add that to the information from yesterday and adapt to what you see in front of you.
That probably, oh, sorry, Barry. I was just going to say that probably leads us to a little conversation on working capital, which is effectively cash and the management of your cash. So we've been saying quite a bit about suppliers trying to manage the payment and the quantum of the payment, at the timing and the quantum of the payment for these suppliers. And again, that all needs to be reflected in your cash flow, and you're trying to control the outflows in your business. Equally, you need to be very focused on the cash inflows into your business, understanding when are you going to get paid. But equally, as you extend further credit, as you do work for people, how are you going to be certain that you're going to get paid for that work in the future? How do you know that your customers aren't going to go into insolvency and you lose at that point? So what can you do? What conversation can you have to? And partly it depends on how much leverage you have in that relationship, as to how much can you shorten payment terms? Can you get paid in advance or on delivery? Now, of course, that means that there's going to be a working capital squeeze somewhere else in the contract chain. But again, if you are in a crisis situation where you're trying to save your business, absolutely, you want to think through every time you extend credit to somebody and every time you have to make a payment to somebody, is there a better way of achieving that?
Okay. One of the, I'm sure it was an inadvertent pieces of fallout from the weekend stimulus package that was announced were the changes around insolvent trading and the levels of demand being increased, both in terms of dollar figure and time, and that doesn't appear to be at all helpful for the smaller end of the SME market. Do you have comment on that?
Well, I think the increases in the amount before you can issue a statutory demand, which for companies has moved from 2,000 to 20,000, that was long overdue. I've seen companies been wound up for debts of $2,000 and a little bit, and that just probably wasn't right. So that change is welcome. Whether $20,000 is the right amount, I don't know. What's more useful, I think, for most companies, or more beneficial, would be the change from it being a 3-week demand to it being a 6-month demand before the creditor can do anything. What that, I think, at this stage is going to mean is that nobody will issue those statutory demands, because they have to wait for 6 months, and in this environment, 6 months is an awful long way away. So I think for smaller companies where they're going to have those level of debts below that, I think there'll be quite a reduction in the amount of statutory demands and winding up at the instigation of the creditors through the courts on the basis of statutory demands. So I think that's welcome and it's positive. The insolvent trading is slightly different, where they're saying that there'll be no exposure to insolvent trading for trading between the 6 months, and I'm not sure if they've set the dates exactly as to when that's to start, because the legislation hasn't been seen by anybody. Or sorry, I haven't seen the legislation. I don't know if it's out. That's all. It's good, and it's very, very helpful in terms of taking that pressure away. You still have to be convinced that you've got a viable business, because directors of companies still have other duties, not to trade insolvently. They still have fiduciary duties to their creditors as well, and that's very important that they consider those. But I think it is good. It takes that one pressure off. I'd still be advising anybody who's concerned about it to seek advice early from their accountants, their lawyers, and if need be, from registered liquidators and insolvency practitioners to talk it through.
Can I just test, is my microphone still working? Yes?
Yes, it is.
Yes, sorry. So to add to that, I think it's worth just taking half a step back. So previously, insolvent trading, I think most people know that directors can be held personally liable for debts they were incurring whilst the business was insolvent. And that was sort of attributed to many directors pulling the trigger and appointing an insolvency practitioner perhaps earlier than they otherwise would have if they weren't exposed to personal liability and they were willing to sort of attempt a turnaround or a restructure first. So the government had brought in some legislation to solve for that, and called the safe harbour provisions, which...
We've lost you, Rob. No.
Is he gone?
We've lost sound from Rob. David, do you want to pick up on safe harbouring while Rob resets the mic?
Okay, I will. Basically, the safe harbour provisions allowed you to continue trading when a time when your company was in financial difficulty without the personal liability. What it required you to do was have a plan that you could, a written plan that demonstrated that it should be in the interest of all stakeholders for the business to continue. Now, therefore, it had to be a written plan, and you had to have an independent expert overseeing the safe harbour provisions as well. So somebody else had to, from externally, an accountant or a lawyer or a liquidator, an insolvency practitioner, had to basically sign off on the plan. My concern with it was that it wasn't really viable for smaller businesses, because by the time they got there, they didn't have the balance sheet that was going to be strong enough to carry the business through that period. One of the requirements was that all of your employee entitlements and associated on costs had to be maintained during the period of the safe harbour. So if you had any doubt about your cash flow during it, you were still at risk. I did have an incident last year where I advised on one. They had a very defined plan. Their defined plan was to sell the business within 8 weeks of going into safe harbour. And that was going to be much better and demonstratively much better than shutting the company down. So they continued to trade, and they lost money during that 8 weeks while they tried to get the sale of the business away. It didn't happen at the end of the 8 weeks. So the company is now in liquidation. That's a poor outcome in some ways, but from the directors and their personal situations, they had the knowledge going into it that they had the protection of the safe harbour. They had a written plan, it was being reviewed regularly, they had external people in with them throughout the process. That's basically what the safe harbour is. The new legislation effectively provides that under the legislation in a defined way, saying that you're not liable for your trading losses, insolvent trading, during this 6 week period.
Yeah, I think
you're back, Rob.
I think I'm back. All right.
Okay. I don't know if you could hear what I was saying. I just gave a very brief overview of the safe harbour.
Yeah, and the crux of all of that is that it was protection as long as you were effectively doing the right thing, informing yourself, having a plan, and implementing it. And the legislation that came through on the weekend effectively gave everybody you were automatically in the safe harbour. So that's a good thing. But of course, if you're doing the behaviours, so you don't have to worry as much about trading whilst insolvent, but it is still an offence to incur debts that you knowingly can't repay or carelessly rack up. That you can still be held liable for that. And indeed, there are still some other. There's still personal exposure for directors for other things. So it may not be insolvent trading if you're incurring costs in the ordinary course, but you still have your normal director duties, such as to be good faith and care and diligence and these sorts of things. And to discharge those duties, you are pretty much doing the same thing you would have been doing in safe harbour anyway, which is inform yourself, so cash flow, financial performance, have a plan, go and talk to your stakeholders, and start actioning it. And of course, they're the very behaviours that will give you and your business the best chance of surviving anyway. The other, I think also, we were talking yesterday that the ATO still has some power to pierce the corporate veil and hold directors liable for some tax debts, in particular unpaid superannuation. But I think the reality is that the ATO will not be issuing director penalty notices at this time, or actually to enforce along these lines at the moment. I would assume. Yeah.
And just Rob, if I could interject on that point.
Yeah.
When the ATO, when the tax office issue a director penalty notice, They work off the address that the director has listed with ASIC as their residential address. And whether you receive it as or not as a director doesn't matter. They just have to prove that they posted it to the address on the ASIC registration. So it's very important that directors make sure that their ASIC filings are up to date if they've moved home. So check with your accountant to make sure that your ASIC filings are up to date, because not getting it, not receiving the director's penalty notice from the tax office is not a defence to being liable for it.
The other, just two other points on directors' duties. One is when you suspect insolvency in your business, directors not only have duties to the shareholders, but they also have duties to creditors at that point. So you do need to be mindful of what the outcome and the impact on creditors will be. The second point is that the government's recently enacted, I believe, some anti-phoenixing legislation. So again, it's a significant problem in Australia. Phoenixing refers to the stripping of assets from one company for undervalue, leaving the creditors stuck or quarantined in the old entity, and then the director restarts the business with the assets that they moved, and so the cycle goes. There are a range of new laws that come into effect from the 1st of April, and anybody thought to have been involved in what they call a creditor defeating disposition, which effectively is a phoenix. There are still some strong penalties that apply, and frankly should still apply even in this time of crisis, because we certainly don't want people taking advantage of the situation.
Okay. We've had a question come in from the audience around how do we think preferential payments will be dealt with going forward?
As far as I'm aware, there have not been any changes to the legislation in relation to preferential payments. First of all, I'll explain for those, what is a preferential payment? A preferential payment is where somebody gets paid more than they would get if the company was liquidated. So if somebody gets $50,000 as a payment, but in hindsight, and it's always looked at in hindsight, if the company had gone into liquidation at or around that time, they'd have only got $5,000, well, the rest can be deemed to be a preferential payment. The couple of things I will say is, firstly, it can only be pursued by a liquidator. It can't be pursued by an administrator or a receiver. So the company has to go into liquidation, and the liquidator then is the person who looks back at all the transactions in at least the last 6 months prior to the relevant date of his appointment and say, did anybody here get payments that could be deemed to be preferential? Preferential means you got it outside the normal course of business. So you had either started legal proceedings against them or were putting extreme pressure on them. Normally we pick them up because they turn out to be what we call round sum payments. You get $10,000 as a round sum, a lump sum, to keep you happy and get you off the director's back. Whereas none of your invoices tie into an amount of $10,000, or you got paid in full. And we then can issue a demand and claw them back. I'm in the middle of a number of those at the moment, where we're trying to get those money back. There's been no change to that. How can you protect yourself if you're a supplier and you want to get paid? How can you protect yourself from being deemed to be a preferential payment? Well, one is to get paid in advance. If you get paid in advance of supplying your goods or your services, then it's not a preferential payment. But there's not not many businesses that can do that at the moment. But it's certainly worth considering, even if it means taking a discount on your price, because you've got the cash, you've got rid of your product or you then deliver your services, and it cannot be attacked. That's one of the main ones. The other one is that you still have to, as Rob said earlier, keep completely on top of all of your customers in terms of who's paying and are they paying within your normal credit terms, and just be very, very mindful of what's. Oh, sorry, something has happened.
No, you're back, David. We lost the vision of you.
Sorry, a call came in on my phone. Sorry about that. And I didn't want to press any buttons in case I got cut out of everything. So preferential payments are a risk of accepting money, and you're sitting there and you've got your customer on the other end of the phone saying, I can give you some money. What do? Do you take it and risk it being clawed back as a preferential payment? Or do you say, no, you hold on to your money because I'm concerned it might be challenged by a liquidator at a future date if and when you go into liquidation? But my basic policy for most people in that situation is, well, if you've been offered some cash or you can get some payments, I take it. Because first of all, the company has to go into liquidation. You don't know if it's going to go into liquidation. Secondly, the liquidator has to issue the proceedings and make the claim on you. And you might have a proper defense. If you've received the money in the normal course of business and you have no reason to believe that the company was insolvent when you received it, then it can't be claimed back from you. Just because you got a payment in the last 6 months before the company went into liquidation does not mean that the liquidator can come around and claim that money from you. Some liquidators try it on everybody. It's wrong. I wouldn't do that. But they have to prove that you knew or ought to have known the company was in financial difficulty and you got it out of the normal course of business.
So David's absolutely right. And a key element there is that you, the person that received the money, had or should have had knowledge that the business was in financial difficulty or was potentially insolvent. And the liquidator needs to prove that. So as a practical point, what can you do? Firstly, as David says, get paid in advance, then you never were a creditor. Or secondly, just be careful what you put in your email correspondence between yourself and the party that owes you the money. Be careful writing things like, or expressing on email the fact that that they are in financial difficulty, because the liquidator will find those emails and use them as evidence to claw back the payment.
Okay. In terms of support for member companies who are worried about their business at the minute, on how they can protect themselves, protect their assets and whatever, it sounds as if early conversations are key, and getting really good advice as opposed to, well, not that we can go to the pub for the bar stool advisors anymore, but getting correct advice. So just to clarify, what's the position in terms of yourself, Rob, and David, in terms of people who might be on the webinar but have a deeper conversation they want to have with you, and they're worried? What do they do?
Yeah, I think David and I will be unified on this point, and both of us would have multiple directors and businesses coming into our office every week. It's a confidential chat, informal discussion around what the options are. That's always free. That's never charged. We're very happy to spend as many hours as it likes to talk people through the options and their position. We know it's a difficult thing to do. We do it all the time. Very empathetic of the position that people find themselves in, and you just need some clear facts, some clear guidance, and an explanation of what the options are available to you.
Yeah, absolutely. I agree entirely with Rob, and certainly Barry, if anybody approaches you and wants my details, and I'm sure Rob's details as well, we're happy to have those conversations directly with them off the webinar.
Great. No, that's fantastic, and I appreciate your help and being so candid on quite a difficult topic for many people at this stage. I will wrap things up at this point and just let everyone know we've recorded the webinar. We're going to make it available on the website. We'll put it through our social. We'll add some links on the website to David and Rob's contact details if they're happy with that. And we've also got some additional resources that David has shared with us that we'll put in that part of the website as well. So if there are any final points from David or Rob, let us know. Otherwise, thank you very much for sharing your guidance today.
I just say that the key takeaways for me are: do your cash flow, manage your cash very carefully, act early and take significant steps early with all your stakeholders, and just be careful who you take advice from. There are unfortunately a lot of dodgy operators that operate in this space, There's now specific legislation trying to rub those sorts of people out. So just look for someone that is qualified with a RETA or a proper professional body.
I would reiterate that entirely, and especially I have concerns with some of the proposals the federal government have come out, that some of those dubious advisors will try and take advantage of the situation. So definitely that. The only other thing I'd add is to be honest with yourself in relation to your business, and be honest with your stakeholders or your spouse or whatever. Don't try and hide these things, because it will have a significant impact, not only on the likely outcome for your business, but also on your mental health, which is a huge factor in these circumstances. And I know Barry has a session on that later in the week, and I'd advise anybody who's got any concerns to log into that one as well. And there's on some of the material, which is from our regulatory body, which Barry will be putting up there, there's links on that there as well. Rob, I'm sure, has seen it many times, the stress that people come into our office under. And we try and help with that as best we can, but I certainly would recommend people to also check into the webinar later in the week on that particular issue. This is very, very stressful, where we have a significant medical issue worldwide that's causing huge financial issues to every sector of industry worldwide.